And as we continue to count down the days to the new year, our next guest says a mild recession is coming in 2023. We're joined now, by Gus Faucher, who is the PNC Financial Services Group Chief Economist. Gus, I was putting all the green up on the screen, trying to tee us up for a really positive and bright conversation, but you're saying mild recession is coming in 2023. What gives?
Yeah, that's right. I mean, obviously, we've seen a big increase in both short-term and long-term interest rates throughout 2022. We're already seeing a significant contraction in the housing market. And I think we're going to see a greater drag on consumer spending on business investment from those higher rates. And that will lead to a mild recession, probably starting sometime in the spring. But it should be more similar to the recessions that we experienced in the early 1990s or the early years of this century, rather than either the Great Recession from 2007 to 2009 or the COVID recession.
Gus, is the housing market collapsing?
It is contracting very, very quickly. So we've seen housing starts. We've seen existing home sales fall by about 30%. We're starting to see house prices decline throughout the nation. I mean, that's not surprising, given that the 30-year fixed rate mortgage went from below 3% in the fall of 2021 to up close to 7% now. Affordability is a big issue. This is what the Fed is trying to do. By raising interest rates, they're making it more expensive for potential home buyers to borrow. That slows economic activity, and the Fed is trying to cool off economic growth in the hopes that that will slow inflation.
Well, to that end, do you think we get an economic soft landing next year?
I think it's going to be very tough to achieve that. I think given the rapid increase that we've seen in rates, given the fact that inflation is still well above the Fed's 2% objective, we are seeing very strong services inflation right now. That's being driven by strong wage growth. And so the Fed needs the labor market to cool off. We really haven't seen that happen very much. So I think we see more interest rate increases from the Fed in early 2023. I think we see a further drag on interest rate sensitive industries. And I think by the time we get to the middle of the year, the economy will be in recession.
Okay, so what's the consumer to make of all this? I mean, we've been talking about a recession for what seems like already 7-8 months.
I want to talk about growth, Brad. I want to talk about growth.
Right. And so for consumers who have now mentally had to weather through the reality or the risk of a recession for 8 months until the end of the year, and then until it actually really hits at some point in 2023, what's the consumer mindset going to be like by the time it actually hits?
I think consumers are actually in fairly decent shape right now. Many consumers still have adequate savings given the stimulus programs and limited opportunities to spend during the pandemic. The job market is still very good. Wage growth is still very strong.
But aren't they taking on more debt right now?
Businesses are going to... I'm sorry?
Aren't they taking on more debt right now? Isn't that showing up in how they're spending? That's showing up in the credit card data that we're seeing come across. Clearly, they're looking for alternatives in their mechanisms of spending as opposed to some of that cash.
No, absolutely. But they're starting from a very good point. So although consumer credit quality has deteriorated somewhat, it's still very good. They still have a lot of savings, even though they have spent down some of that savings. And so I think that consumers are, pretty well positioned heading into a downturn this time around. Certainly much better than what we saw, for example, in 2007, 2008. The other thing is that I think businesses are going to be reluctant to lay workers off this time around, given the current tightness in the labor market, and they don't want to be stuck when the economy comes out of recession in late 2023 with not enough workers. So I think that job losses will be fairly limited, and that the downturn is going to be concentrated in housing and consumer spending on durable goods, and then business investment.
Gus, is this going to be the recession that most of us just won't feel? And I'm looking at, let's say, I go to a Starbucks right now, Gus, over the last week, and I was run over by 15-year-olds. The place was packed.
Yeah, no, absolutely. I mean, you were talking about the theme parks, for example, and people are still spending there. People haven't been spending. They haven't been going out because of the pandemic, so they're still spending there. I think that this should be a pretty mild recession. I think this is going to be more like the recession of 2000, 2001, or the recession of the early 1990s that is going to cause pain, particularly for people who are in housing-related industries, people who are in heavy manufacturing. But I think that many consumers will hardly feel this, to be honest with you.
All right, let's leave it there. PNC Chief Economist Gus Faucher, always good to see you. Happy New Year.